Hello, YouTube. Welcome to another episode of Archer Investing. Just quick disclaimer, I am not a financial advisor. Nothing I say or do is financial advice. This video is just for entertainment and educational purposes only. So without further ado, let's get to it. So here we have Robinhood Markets, ticker symbol HOOD, HOOD. Today I want to talk about selling puts. I believe I mentioned in my last video, I'm not too 100% sure, but I will be doing a portfolio update at least once a week. Might be doing it Monday or Tuesday. We'll kind of see how the day goes, if I get off early from work or not. But that's just a quick update about my portfolio. So it will be at least once a week, maybe twice. If, like, for example, one day one of my stocks just jumps up 10% or I make a massive trade, that will probably be like the second portfolio update. But back to selling puts. My last video, I talked about selling calls. I figured I'd talk about selling puts because that pretty much completes the wheel strategy. I'll briefly mention the wheel strategy in the end, if I remember. But yeah, so selling a put, same thing as selling a call. When you sell a call and you sell a put, you will be getting a premium. So that is the juicy part. And then with selling a put, so when you're selling a call, how I mentioned before, you are agreeing to sell your shares at an agreed upon strike price. With a put, you will be agreeing to buy the shares at an agreed upon strike price. So you'll be getting into the stock, not getting out of the stock. So in this case, it is best to sell puts on stocks that you want to get in, stocks that you believe in, and stocks that are safe. You won't be selling a put at a stock that's very volatile, very unpredictable. You know, the company's crashing or whatever. The premium might be juicy, but it's probably not best to sell a put then and there. So pretty much, let's go here, April 24th. So as I said before, you'll be selling a put. When you sell a put, you'll be agreeing to buy the stock at agreed upon strike price. In this case, this one will be $70 here, $70 put. You'll be getting $5 per share, so you'll be getting a premium of $500 because you can only sell a put at 100 shares in order to sell a put. So in this case, it'll be 5 times 100. You'll be getting $500 in premium. But since you're selling a $70 put, it will be 70 times 100 shares, which is $7,000. That $7,000 is how much money you need to have in your buying power in order to execute selling this put. I am not 100% sure if you could do it without having that $7,000 buying power. I don't think Robinhood lets you do that, but I might be wrong. I never tried it. But that's just something to take into account. You don't need the shares to do this trade, but you do need the buying power to get into the trade. So in this case, it will be $7,000. Or it could be $6,500 for the $65 put. But you will be getting a lower premium. However, with the lower premium, there is of course, lesser possibility that you will get assigned to the $65 put compared to the $70 put, just because where the share price is currently at right now, $71.45. It is a lot easier to get assigned here versus the 65. And then plus, with it being 65, you never know. April 24th, the stock could shoot down to 60. It is safer to have it at 65 than 70. So that is one thing to take in consideration. You know, don't always chase the premiums. Might be better to play conservative sometimes and take the lower premium, or sometimes you don't even want to take the trade at all. You know, maybe you think Robinhood, even though it's at a downtrend, maybe you think it's going to shoot down to 60. In that case, probably wait until it gets like $62, $60, sell it put there. But, use your best judgment and obviously do the research on your stocks before you make any of these options trades, because option trading is risky no matter what. You're buying a call or a put, or selling a call or a put. It's risky no matter what. The selling side is a little bit more safe, but it does limit your potential upside and could screw you over in different ways. In this case, let's say you sell a $70 put, and then the market opens up on Monday and it just shoots down to $45. Most likely your put will get assigned, and then you have a $70 contract here that you can't even do anything with, because Robinhood is at like $45, by April, whatever, for April 24th. So your 100 shares of Robinhood are just sitting there. And that's kind of why you want to do it on stocks that you want to get in, stocks that you don't mind holding for like the long term, because plays like this can happen and do happen. And, that is a risk that you'll probably have to take. Maybe you're stuck holding the stock for a little bit. Maybe you're not. Maybe the contract expires worthless and you make your $500. But yeah, same thing with the calls. You do get a premium. And then back here, delta 0.42. That means there's a 42% chance this trade will execute. And meaning that you will get assigned. And then if you go down here, 32% chance. And then here, obviously, there's a nicer premiums, 77. There's a 61% chance. So, you just kind of want to do whatever you think it's best. And then just like the selling costs, the further away you go, the better premiums you'll get paid. So in this case, a $70 put, you'll be getting paid $15.50. 65 will be $12.80. But that means that, the $7,000 for the $70 put will be locked up until March 19th, 2027. Now, you can exit the trade early. You don't have to stay until the expiration date. And I'll show you why it makes sense to exit the trade early sometimes. Actually, let's use it on. Let's go to this one. Let's say Monday opens up and then Robinhood just shoots to like $80. So $80 right here, simulated returns right here, $229. In this case, it might make more sense to exit the trade, because you pretty much, let's say you bought this on Friday before the market closed, and then come Monday, Robinhood opens up to here or closes here or whatever. It might make sense to buy the put back, because you'll be buying it at $1.31 per share. In this case, you'll be spending $131, but you sold the put at $360, so you made the difference as profit. So I think that will be like a smart time to leave. Also, you can just hold it, which is most likely what will happen. As time goes on, time plays in your favor, the same thing as selling a call. So as you can see here, as more time passes, the more money you make. And the good thing about this too is, let's say the stock goes against your favor. Let's say it goes to like 68. Right here, you're still making profit just because theta is decaying and this contract is losing value, which helps you out, not the buyer. And that's why it's also more risky to be in options as a buyer because time is against you. Here, the stock lost about over $3 worth per share, yet you're still making profit at $110, So that is another nice thing about selling calls or puts. Yeah, time is always in your favor here. But one thing I don't think I talked about for my selling call videos, theta, when it's like pretty far, theta is very minimal here. So it's very small. So theta doesn't decay as fast compared to like a month out. So there is another strategy, not selling a call or selling a put, but buying a call. There is a strategy called buying a call like over a year out, which is like a leap. That's another strategy that I might make a video on, but it is a pretty smart strategy. Still risky, but it does require more capital. But it does have potential to make you a lot of money. But at the same time, you could lose out on a lot of money too. But it is a strategy that I have used. I have made money on it before, but I've lost money on it too. So yeah, so back to selling and puts. Get on stocks that you believe in. Stocks that are more safe. And then stocks that you already want to own in the first place, because as when you're selling a put, you're pretty much going to get into that stock if you get a sign. You're not going to get pulled out of it like selling a call. That does kind of complete the wheel strategy pretty much. With the wheel strategy, you'll be selling a put to a stock you want to get on. And then once you get assigned to that stock, then you'll go back and you start selling a call. And then once that call gets assigned, go back to selling a put, and then vice versa. Just keep going back and forth, kind of like a wheel. But yeah, that's pretty much it. I don't think I missed anything. We talked about theta, delta. Let's see. Yeah, I think that's it. The last thing is that, everything you do is risky no matter what. This stock could drop $30 per share the next day or whatever. So that's why it's always good to get in the stock that you like. Other than that pretty much ends this video. Let me know if I missed anything. I don't think I did. I'm not too sure. Yeah, I'm not really going on a script or anything like that. I just kind of, just start making the video. But yeah, let me know what stock you guys are investing in, any strategies you guys do. And then, of course, if I missed anything on the selling puts video or the selling call video that, that is important. But yeah.